Thank you all so much for joining our webinar today, Dialing in Accounting, Cash Flow, and Tax Strategies. We have quite a few great topics and a panel of speakers to get started with, but before we do so, we just want to start with a couple quick reminders. So questions are welcome today throughout the presentation using the chat feature and the Q&A. You'll be able to find it on the bottom of your screen. Additionally, a lot of you sent in questions prior to the presentation, so we're going to weave those in throughout. So we really look forward to that. Additionally, the session is being recorded and will be made available to you via email and on Yearend.com. Always happy to share that in addition to the slide deck. So a PDF copy can be found in your chat feature. Additionally, that will also be included in the email. With that, we're going to go ahead and pass it off to our panel of speakers today. John, take us away.
Oh, thank you. Good morning, everyone, and welcome to another installment in Raymond's webinar series to help provide the most up-to-date current information related to so many of the important ever-changing business and regulatory things that we find ourselves in these days. Between COVID and the new stimulus packages and everything that comes in, along with year-end tax plannings and planning for 2021. We hope that today will give you some things to think about and some good takeaways. So today, along with myself, John Pritnia, and Tom Szymanski and Tony Licavoli, we'll be talking about the topics in revolving around forgiveness of the PPP, what planning might be available, what's currently known and maybe unknown as it relates to PPP forgiveness. Tom will get into more cash flow, year-end budgeting for 2021 and wrapping up 2020. And Tony's going to get into more specifics on what tax planning is available short-term, what's available long-term, and maybe a little look ahead about what post-November 3rd might look like, depending on what happens with the elections as it relates specifically to taxes. So let's get right into my side on the PPP, and let's first take a polling question. If you can give us some insight, the three of us speakers, have you applied for a PPP loan forgiveness? And if so, give us a little idea of what time frame you've done that. We'll give you a couple seconds on that before we get into the discussion. And I'm seeing a significant amount of people in the yes, we've already applied, and others that will apply by year end. It's pretty close between the two. Well, good. Let's go into a little bit of the specifics on PPP then. So the reason I wanted to ask, have you applied? A lot of the strategy revolving around loan forgiveness comes not only in the form of what form to prepare, what expenses you include. When they changed from an 8-week to a 24-week forgiveness calculation coverage period, it really opened up the aspect of you really should be able to get full forgiveness. And now that you know you can get full forgiveness, the next planning is, when do I apply? Because we all know that, well, you may not be aware of this, but I think you've heard a lot of the discussion. IRS Notice 2020-23 came out where Treasury said, to the extent that you pay for expenses with this money that is now a tax-free loan forgiveness based on the actual legislation that was put forth in the stimulus package, those deductions are not deductible. And I'm going to talk a little bit later about what might change that aspect. But knowing that, one of the biggest planning opportunities is try to defer that non-deductibility into the next year, into your next fiscal year or the next calendar year if you're a calendar year taxpayer. And how do you do that? Well, the only way you can do that is really time when you submit your application and hope that the time frame that your bank and the SBA need in order to process that claim will not result in a forgiveness acceptance until after 12/31/2020, thus putting it into 21's taxable income, or I should say non-deductibility, so it results in taxable income, and maybe even pushing the tax payment out until April 15 to 22. So it gives you a lot of opportunity in the payment of tax. Let's first talk about if you've already applied and then now you've gotten forgiveness, then you got to be ready, because April 15th, you may have a tax liability. And this brings up the important topic of the legislation. We know that Congress did not put specific language into this on the deduction. They only put in specific language that it would not be taxable income on forgiveness. Treasury's position, we know under Section 265 says that it will not be deductible for certain reasons. There's some discussion out there as to whether or not their argument is legitimate. I would say that those positions, if you do take them on tax returns, are quite aggressive. But we do know that there's a lot of discussion. There's actually bills being written and may actually have already been submitted in Congress that will provide a specific a bill that will provide deductibility for these expenses. The hope is that we'll hear about this before the end of the year. There appears to be bipartisan support on this. Once the elections are done, we're hopefully that it will be streamlined, and we'll see an opportunity to be able to deduct those. But for right now, the best opportunity to plan for when is the forgiveness is to push those deductions out till as late as you can in 2020, just to ensure that even if they don't get that bill produced until 2021, maybe to be retroactive, but at least burden the hands worth two in the bush, take advantage of those opportunities to time when and if that non-deductibility comes into place. The second item I wanted to talk about are the gap issues. Gap issues are really important because as if you've got a banking relationship where you've got a loan on the books outside of this SBA PPP loan, you know that you've got to meet certain covenants. And those covenants may be impacted by virtue of another loan on the books from the SBA and your PPP loan. Make sure you're talking to your bank, not only from when I can submit my application, when should the bank release the PPP application to best time, as we talked about just before this, but also how's it going to impact my covenants? And what happens if those covenants are affected by the PPP loan? What do we do for 2020 so that we don't violate any of those terms? And I do know that many of the banks that we're working with are really considering what does that mean, how does that look, and how do we move forward into 2021? And then again, on the forgiveness side, just note that your financial statements are going to look very different both in 20 and in 21 by virtue of the PPP loan. So make sure you're working with your banker specifically on what my financial statements might look like and how will that impact my covenants. So with that, that's a brief update of where we're at on the PPP loan and the planning forgiveness. I'm going to turn it over to Tom and let him go more into cash flow.
Yeah, just before we get into cash flow, just a couple legislative type updates and things on the forgiveness application process. Some of the recent things that have come out. One is a lot of you may have noticed that there's an October 31st date on a lot of the applications. The SBA came out, clarified that they will be updating that, and they really put some better timeframes around when you need to submit your loan forgiveness application. They actually recently said that you could wait until the end of your maturity date, which could be 3 to 5 years, and still wait to that point before putting your application date in. Now, obviously, the thing that most people are looking at is there's a 10-month window of deferment after the end of your coverage period. So if you're on the 8 or the 24-week coverage period, when that time is up, that starts the clock on a 10-month grace period. And at the end of that 10 months, if you haven't applied for forgiveness, it'll automatically convert that to the loan and payments will start. So remember, there's 2 stacked up periods on the forgiveness processing. The bank has 60 days to process, and then the SBA has 90 days to approve. Now, we are starting to see, we've seen a number of banks that have actually got approval from the SBA, have gotten the payment from the SBA, and have discharged some of these PPP loans. So, I think what we're going to see is that processing timing is going to get quicker and quicker as everyone gets online with their systems. But we're starting to see some forgiveness getting through the entire process in about 30 days. So it really depends on your bank and what their kind of working relationship is to get those through. But the SBA, and these are probably loans smaller, less than the $2 million that we're seeing starting to get turned fairly quickly in some instances. And then the other is there was a new form also put out. 3508, I believe it was S, but it's a really straightforward loan application for forgiveness for those under $50,000. So it's simply just kind of a test that you got the loan, you spent it properly, you have the information, but you're just attesting to it, signing it, and sending it in. So for those loans under 50,000, it's a very straightforward process. There still is the easy application and the full long form. So, but that was a new release as well. And then I think, the big thing to keep an eye for is just the FTE calculations. There's a safe harbor 1 and 2, and then the traditional kind of calculation of coverage period versus your reference period. So I think we're seeing a lot of clients, if there's this area that it struggles, is which form do I use and how do I address the FTE calculations? Again, especially for those loans over 2 million, where you will have an audit somewhere down the line, we're really encouraging clients to take the approach that's the easiest to document, the easiest to kind of walk through that audit process. And in many cases, that is the long form with the FTE numbers that are easily calculated and shown. I think what we've seen is since 24 weeks, the expansion to 24 weeks in coverage period, it's really made it much easier to get that full forgiveness just using the kind of standard calculations. So those are some of the key issues that if you haven't filed your forgiveness, sort of keep an eye on and to be aware of as you're working towards filing your loan application. And then I think the other thing is just documentation. Every bank will be different, but they're going to want existence documentation like 941s and payroll reports and maybe bank statements, and then they're going to want support for how you got to your numbers. Summary payroll reports over your coverage period that makes it easy to see where you aggregated your numbers for your payroll numbers and things like that. Support schedules and things that maybe kind of break down your health insurance and some of your rents and things like that into a way they can easily see how you got to your numbers. So anything you can do to make that process easier on your bank will help get your applications through quicker. So that's it on the SBA. Why don't we slide into conversation on kind of 13-week cash flow and cash management. And again, why don't we start this with a poll? I think, a lot of people, cash has become much tighter. And, the question is, what's my visibility? I mean, as a business owner, as a president or CFO, do I know exactly where my cash position is over the next 1 to 2 weeks, 2 to 4 weeks, 5 to 8 weeks, or is it just limited? I just don't have maybe some of those tools internally, that I need to have to help manage my business. And this is, and I would say I work in the CFO services group at Raymond. So my group does a lot of fractional CFO work, and I'd say cash management is a big area that we focus on in helping companies get those tools, because with the PPP loans, have run their course. A lot of folks are dealing with revenues that are less than what they projected. And so it leads to some challenging cash management. So looks like the poll is telling us about 67% feel they have pretty good visibility in the 5 to 8 week window. The next is 2 to 4 weeks at about 20%. So yeah, it sounds like most of you have a pretty good system, at least for having some insight into your cash flow. And I think, the standard, from the bank's perspective, it's pretty common that they're looking at that standard 13-week cash flow. And I think that's really the tool that a lot of folks probably are utilizing in one way, shape, or form. And I think, that's the question that, you kind of have to ask yourself is, what tools do I have? And, are they giving me the right kind of benefits to help me run my business? Some of the benefits of a 13-week cash flow is really that visibility, because what you're trying to do is, this is a cash basis. You're trying to project, when are you going to get cash in? When do you have to actually spend it? It's not really a balance sheet approach. It's really more like a sophisticated checkbook. And so it really drives you into your planning process to get really engagement across your entire management team. What's going on the sales front? What's going on in our material buy side? What are we doing for employees? What's their staffing levels look like? A 13-week cash flow model can really help, kind of get your team to work together to say, what's going to happen over the next, 4, 6, 8, 12 weeks. For a lot of my clients, we're really driving for about 20 weeks of cash flow, and so that incorporates everything on the accounts payable and accounts receivable side that we know of, and incorporates our plan for the next 30 days or 45 days from a production schedule. And then we roll in our forecast. So you think about it, we've got 3 different phases that we're trying to kind of integrate in together in some kind of structured format. So having that 13-week cash flow allows you to layer in those 3 areas and really get that longer term, 12 to 20 week kind of snapshot. And it's really great for trending. Sales are slowing up. So what does it look like if my next 2 months are 15% down? What does that do to cash flow? Because those are all things that I think, especially during this year, if you don't have that visibility, it's made it difficult to maybe understand how to maximize your PPP funds or any other, programs that maybe you had the benefit of using. And then how do you bring people back into work? I know there's an intent of PPP, but then there's the cash flow side of what do we need to really manage the business over these next 20 weeks. So I think that's really, the focus of a 13-week cash flow. And I think if you're in, particularly if you're in project-oriented type work where you've got larger investments in materials, or you have to buy large batches of material, let's say steel or resin, where you're buying truckload type quantities, where your payments are a little bit lumpy because you've got those payments once a month or once every 6 weeks. I mean, that's where you really need to understand, where's my low point? Most businesses have 1 week out of the month, which is their low cash point and their low availability on their line of credit. You really need to manage to that low point, not your month-end balances, right? You need to understand, how to make your cash work in those times where the availability is going to be very tight. So I think those are just some things to consider, on the cash flow side to really try to get that visibility in your business. Now we're going to kind of switch over to Jen to talk about some year-end considerations, some things you should be thinking about.
We talked a little bit at the onset about the need to work with your bankers, talk about loan covenants. We talked about the timing. One of the things I think I want to make sure that people understand as to why the legislative change needs to take place, and this is in direct correlation to cash flow. Consider that if you did what the PPP loan required of you, you kept your people on the payroll, you may not have been open. I'll take a specific example. Let's say you're a restaurant, you were forced to close, or you were a dental office and you were forced to close. But you kept your people on the payroll. You didn't bring them on unemployment. They continued to work. That was what you were supposed to do. You spent all your money. Now you submit your application, get forgiveness. There's a 25 to 35% penalty now because you would owe income tax because of the non-deductibility of those expenses, those payments. And right from the get-go, it was very clearly spelled out that this was going to be tax-free money. Yet, if you have a 35% penalty or an additional payment that's due April 15th of 21 or 22 if you defer it, it's still not right. It's still not what the intent was. So again, we're hopeful that the legislative members of Congress will fix that, and we're trustful that they will. But as Tom said, the cash flow is going to be important, and that's one more item you need to factor into the maybe what if it doesn't get fixed. When does that cash flow hit, and make sure that it's accounted for.
So, the other thing that we're talking with clients a lot is kind of what are we doing on the 2021 budgeting process? That planning phase. It seems like sometimes there's some folks that there's so many unknowns. They don't know where to start. They don't know what to do from a planning standpoint. Do I use? It's hard to use 2020 as a baseline because we had 2 months if you were shut down with the stay-at-home order that really messed up a lot of numbers. Do I go back to 2019 as a bit of a baseline? My revenue levels still haven't come back. So I think the overlying theme is that in a year like this, it's even more critical to start your planning process sooner, to be more detailed with it. Again, when we talk about tools, having an integrated financial modeling system, that builds out your revenue assumptions, your gross margin assumptions, feeds your income statement, link to a balance sheet and a statement of cash flow. I mean, this is the type of tool that, you should be working on to help, plan out various scenarios, because, that's what it boils down to. Is there's a lot of what ifs that we all need to be considering heading into next year. And I see the biggest challenge with a lot of clients that we're working with is, what do I do with overhead? I've been traditionally a 12 to $14 million business, and I've been running at 9 million, for the last 90 days. And I just don't have clarity of what next year looks like. And we've got a $14 million overhead structure. So there's a lot of businesses kind of faced with this kind of restructuring exercise of almost re-engineering how they do some aspects of their business, because they don't have clear insights. And the last thing you want to do is continue to burn cash, waiting for the market to come back, waiting for some things to go back to normal, because that's the new thing. Is this the new normal? Where is my business going to be, for the next 12 to 18 months? Most people have already taken a hit to their balance sheet from an equity and a cash flow standpoint with a tough year this year. So it's just really critical to really jump into that planning process and have some more detailed analysis of where's my overhead structure, what adjustments do I need to make? And then the other big push I see a lot of clients working on is sales revenue, looking at different sales channels, looking at, what diversification can they do. I know a lot of people did try to shift into the PPP or the PPE type safety area, when there's a big need. But it is it is a question, if you've been fairly comfortable in your revenue streams and your customer base, now's the time to probably get out of that comfort zone and start looking for things outside of your core, to diversify a little bit, look at some revenues, maximize on your core competency. Stay with what you do good, but what you do well. But can you get that into some other customers? Can you bring your expertise into other markets? Because your traditional revenue growth plan, might not be the same heading into next year as it's been, just because of the impact of COVID and what we're seeing on overall sales volumes across a lot of different industries. So I think it's time to make your planning process a bit more dynamic. It's time to be a bit more detailed and take a hard look at the overhead costs, because we're just at a point where no one's got a crystal ball. But before it might have been a little cloudy. Now it's now the visibility is about 6 inches in front of our face, unfortunately, and so we got to be able to react quickly. So having tools that we can quickly change assumptions, assess impact, and then adjust course is really the kind of tool that you need to help plan for 2021.
Hey, Tom, before we switch over to Tony on some of the specific year ends, just a couple of ideas, maybe examples of what we've been seeing on the budget process from customers as they start. I know I've seen maybe thoughts about just go back to 19 and use that, maybe develop a budget that is two budgets, one that is post-COVID or continued COVID. What are you seeing out there?
Yeah, some folks are using the 2019 as a bit of a baseline, but really for a lot of clients, it's probably been more so. I won't say starting from scratch, but just really relooking at their entire planning process. Yeah, just a whole new look, because there's too many changes to maybe use what they've used in the past, because revenue levels are different, headcount levels are different. Their overhead cost structure needs to be reviewed. So they're really kind of rebuilding all those areas as they're heading into 2021, just because of the uncertainty.
Got it. One quick response to a question, and I'm going to hand it over to Tony. It says, have you heard anything about loans under 150 that would be automatically forgiven and no application? Well, we do know that the 50,000 was put into place, and we're understanding that they're working on increasing that. In fact, I was on the phone with a bank this morning, and they are holding up any of the applications that are under 150 under that assumption that things may come in. Tom, you have any more recon on the 150 beyond that?
No, I think the 50 is here now. Whether we get to 150, we'll find out probably more after the election when some things start to move. But similar feedback. Some of the
Got it.
bigger banks are holding off on that 150 mark or putting it to the end of the line as far as their sequence of accepting applications. Just holding out hope that something will be done
Something may happen. Yep, that's what we're hearing too. All right, with that, we're going to shift over to Tony Licavoli. Tony, will you take over?
All right, thank you, John. So we're actually going to start off with a polling question and to kind of gauge what people's impressions are of a potential change in the White House. So the question is, what will an election or a win by the former vice president have the impact on my business? And we're kind of focusing on the business side here. So number 1, overall positive, 2, negative, 3, neutral, and then 4, I don't know. I just want the election to be over and done with. And while everyone's answering that, a lot has happened over the past 6 months that really impacts tax planning and opportunities on both the business as well as the individual levels too. And again, with the election coming up, things could continue to change if we end up seeing a shift in tax policy. So our discussion today is going to cover 2 areas. It's going to be on the planning both for the short and the long term, and then thinking about how the election could impact these areas. So looking at the polling results, about what I expected, about 46% said an overall negative due to the increased tax burden. The second highest one was, I don't know, I just want the election to be over with, which I'm sure probably more people feel that way too. So the one thing I would say is, it may be hard to believe, but, sometimes candidates will say things they don't actually intend to do, and really probably more likely that the intent is there, but they are unable to do these things for various reasons. So I'd say keep that in mind throughout the presentation, and especially when we get to the election section. So let's start out by establishing an overall framework for our discussion today, and really for the strategy section. And the easiest way for me to think about things and think about tax planning or tax strategies or tax minimization, whatever word you want to give to it, is to put things into different buckets. And I think using the term short-term opportunities and long-term planning, and the keywords there being opportunities and planning, really put together this framework for our discussion today. And short-term opportunities, think of this as, it's not a hard and fast rule, but think of this as something that's going to be a year or less on the time horizon. And, short-term opportunities are really about these 2 things when it comes to tax. And that is, generating cash tax savings through various mechanisms like refunds, taking advantage of various tax credits. And then the second item on there is, using any available means to defer paying that tax. So maybe you're not lowering your overall effective tax rate, but you're deferring those payments into future tax periods. And then, long-term planning. So if we're going to say short term is a year and under, long term would obviously be something a year and beyond. And it's really about, it's really about looking down the road and thinking about what could be coming your way. So it's not necessarily about acting now, although there may be steps you want to take, but it's really about being ready to act, if and when that future event actually happens. So, again, a great example today that we'll discuss are going to be those potential changes from the resulting election. So if we can move on to the next slide, let's get into a little bit more detail about short-term tax opportunities. And this slide here is really just a summary of what's happened, over the past, 6 to 7 months. And the first 2 have sort of run their course. We had changes to due dates. John talked about direct payments to businesses and the payroll protection loans. And, we're going through that forgiveness process right now, although we're not certain about the tax impact on that. But then the last two, the payroll tax incentives and the income tax changes, let's discuss in a little bit more detail now. So moving on to the payroll tax incentives in the next slide, the first thing on there, and all of these focus on this slide focus on payroll tax incentives, but the first thing on there is the employee retention credit. And we've talked about this before on several of the past presentations, but basically this is a payroll tax credit up to 50% of certain wages, and it's capped at $5,000 per employee. So think of it as a $5,000 per employee tax credit if you qualify. And this is temporary. It does expire at the end of 2020, but there has been some talk on both extending this credit and expanding this credit with the next stimulus package, if we end up seeing one happen. So the main limitation on this credit is that you're not eligible if you received a payroll protection loan. So right there, you eliminate a lot of businesses that did take advantage of the PPP loans. But if we're looking at a planning or an action item here, if you did not receive a payroll protection loan and you aren't taking this credit, I would definitely make sure to reach out to your advisor because we've spoken with a lot of businesses over the past 3 or 4 months that didn't think they were going to be eligible for this credit for various reasons. And there is the ability to actually go back and claim this credit on some amended forms. So moving down to the next bullet point on there, there's this FICA tax deferral for employers that allows employers to defer paying a portion of their Social Security tax, the 6.2% Social Security tax. Now, this is available, but this shouldn't be confused with the president's executive order that came out a couple months ago regarding employee payroll tax deferral. So, the one on the slide talking about the employer portion, but the president's executive order was specific to employee payroll taxes. And that, this allows for deferring of the employee's Social Security tax at the discretion of the employer. So one question that came in ahead of time is, are we seeing many businesses actually offering their employees this deferral option? And, the answer is no. We've been advising clients to not adopt this deferral for a couple of reasons. Number one, it does end up exposing the employer to additional liability if for some reason they can't actually collect from their employee. So let's say that employee actually leaves in their employment, and then really it's extra work for the company for this sort of confusing short-term loan for the employee. So based on those couple things, we've actually recommended our clients strongly not to adopt this, and we haven't seen too many that have chosen to. So we'll skip over the next one. Can we move on to the next slide? So those are focused on payroll tax opportunities. The next slide is focused on income tax opportunities, and specifically how they relate to the CARES Act. So the first item on there, modifying the rules related to net operating losses or NOLs. So you can carry back the losses that you incur in your business up to 5 years. So that means there are going to be opportunities to amend or file carryback forms for any losses that you incur in 2020, and to both utilize these losses and potentially to carry back those losses to a higher tax year. So if we're looking at an example, let's say your business operates as a corporation, and currently your tax rate is 21%. So you incur a loss in 2020, and you carry back that loss. Let's say you go 5 years back to 2015. Well, the max corporate tax rate in 2015 is 35%. So not only are you getting the benefit of getting that immediate cash refund by carrying it back, but you're also getting the benefit of that spread in the tax rate between 21 and 35%. So the next bullet point on there, definitely a big one, the technical correction for qualified improvement property, which is basically fixed assets that are internal improvements to a building. So, some background here, there was an issue with the wording on one of the provisions back in 2017 when we saw the Tax Cuts and Jobs Act pass. And it turned this specific property, qualified improvement property, into 39-year property. And the biggest impact there is it no longer made it eligible for bonus depreciation. And right now we have 100% bonus depreciation. So the CARES Act that passed earlier in the year actually fixed this, and the effective date for this provision was for property placed in service after 2017. So it is actually retroactive. You can go back a couple of years and fix those assets that were placed in service and you didn't take bonus depreciation on. So really the action item or your planning item here would be really going back through your fixed asset schedule and determining if any of those older fixed assets are now eligible for bonus depreciation because of this technical correction to qualified improvement property. And we're going to skip over the next one and move on to the next slide, because I want to talk about some planning ideas that aren't related to the CARES Act. They're more related to sometimes economic downturn and sometimes just generally good ideas to be thinking about in any year. So the first item on there are cost segregation studies, cost segregation opportunities. And this is basically a technique of accelerating depreciation deductions for real property that you place in service, like a building. And, so I'd say, if the action item here would be, if you have purchased or really renovated any real property over the past couple of years, it's definitely worth discussing with your advisor to see if a cost segregation study does make sense in your specific situation. Again, it's going to depend on the amount of improvements you placed in or the cost of the building to see if it's worthwhile. And again, we talked about qualified improvement property on the last slide. We're talking about cost segregation or depreciation on real property. So, the focus of planning is generally geared around, if we're looking at fixed assets, it's generally going to be geared around real property versus personal property. And what it comes down to is that, you're able to take a depreciation deduction on personal property. Let's say you place in service some machinery or some equipment. Well, first of all, you're able to take 100% bonus depreciation on the asset. In very few limited circumstances, you aren't. So you get an immediate write-off for that asset, like machinery. So for most personal property, you'll be able to deduct that amount on a tax return immediately. But for real property, you're generally looking at 15 to 39 years to depreciate that asset. So missing out on any available accelerated depreciation, like the 100% bonus depreciation on a building, really forces you to take that deduction over a much longer period of time. So that's why we focus a lot on planning. We talk about real estate rather than personal property. Now, the second bullet point on there, business bad debt deduction. So again, something that's is definitely more prevalent during economic downturns. But for book purposes, you are probably looking at your receivables, evaluating collectability. You may end up in the end creating a reserve or an estimate for the amount that you don't actually expect to collect. Now, that's for book purposes, but for tax purposes, we have a different set of rules. You actually have to wait until the specific debt becomes worthless. Now, it can be wholly or it can be partially worthless, but you have to wait until that happens before you can deduct it on your tax return. But the good news is the IRS really hasn't adopted any bright line of test when it comes to determining whether a debt is worthless. So it's really going to be based on the facts and circumstances in each individual business's case. So, going back to planning items here, or action items, it'd be basically walking through your AR schedule, especially looking at your more significant AR accounts, and really working with your advisor to help determine if there is enough uncertainty of payment to meet that tax deductibility standard. So the only thing I would say with this is, one thing to keep in mind is, on the tax side, if you're going to deduct it, you generally have to be consistent on the book side as well. So keep in mind how your balance sheet was going to look in terms if you end up deducting a bunch of, or end up writing off a bunch of AR just to claim that tax deduction. Now, moving on to our last bullet point there, the inventory write-downs. Really quickly, it's about looking at your inventory and saying, is there any potential loss of value in that inventory? And it's a little more complicated than just saying that you have a loss of value. There are processes in place for tax purposes that you have to go through before you can actually deduct it on a tax return. So your planning item here would be, if you actually believe your inventory is substantially worth less than what the cost or what you paid for it, for more than just the reason that you can't currently sell it because of a market downturn, I would reach out to your advisor and discuss the options for taking any immediate tax deductions when you write down that inventory. And if we can move on to the next slide. So those were kind of sort of the short-term, 1 year or less planning ideas. The next one is going to be long-term, but again, I'm only going to spend a minute or two on this because I do want to get into the 2020 election considerations, mostly because the election is going to be a big driver behind any long-term planning considerations. So the first item on there, business restructuring, and the first bullet point is really thinking about your current business tax entity classification. So, should you stay as a partnership or an S corporation, a flow-through entity, or is it time to consider converting to a C corporation, a corporate entity, because of that 21% tax rate, that lower tax rate? The second bullet point on there, it's really looking for opportunities to simplify your reporting requirements. So on the tax side, it would be looking at, if you operate through multiple filing entities, can you somehow merge or combine or consolidate those entities to simplify your reporting requirements, with the key item being here without any negative tax consequences to you. And then the third is evaluating your international operations. So back in 2017, we saw a pretty significant change in the way the U.S. ends up taxing international operations. So it's really thinking about, have we properly adjusted for those changes on the international side? Now, the second item on there is succession planning. Definitely a hot topic right now, especially with the election. So the first thing on there is, considering the impact of any valuation changes on gift and estate planning. So really, it's really thinking about, have decreased valuations allowing, have presented an opportunity for more tax efficient transfers. And really the planning item or the action item here is thinking about, when is the last time you had your business valued? Because now really seems like the time to do so if it has been a while. So we're actually going to move on to the next slide and wrap up our discussion with really focusing on the former vice president's tax proposals. I want to very, very briefly talk about some of the items that President Trump has mentioned. Again, we're going to call them proposals on this slide, but they really aren't proposals in the sense that they're part of some overall plan. There's just a couple items that he's brought up over the past year. So the first item on there, making permanent the 2017 Tax Cuts and Jobs Act. So most of the individual provisions from that 2017 tax law do actually expire by 2026. So this includes some pretty big items on the individual side. You're looking at the overall individual tax rate cuts would expire. And then also on the business side, the qualified business income deduction, which is that 20% deduction on your partnership or your S Corp business income, that actually expires as well by 2026. So, without getting into any reasons why they were set up to expire this way, the president, as well as most Republicans who took part in passing that law, want to make sure these do get made permanent, or I guess at the very least, they want to make sure that these do get extended past that 2025 date. So let's actually skip over to the next slide and talk about the former vice president's proposals. Because again, the items on the president's slides are, again, just things that have been brought up. They're not really part of any comprehensive plan. But these items are. So, obviously looking at these items here and thinking about what happened back in 2017 and what items were included on that last PowerPoint slide, there's obviously a much different approach to tax policy here. And, as I was telling the last group of attendees on our last presentation, there's not really any other way to word this than that, the president's proposals, again, are about or focused on tax cuts. Well, the former Vice President Biden's proposals are really about raising taxes for certain groups of taxpayers, not all, and not anywhere near to all, and also offering credits and incentives for other groups of taxpayers. So, let's get into some of the actual individual and business proposals, and let's focus on the left-hand side of that slide on the individual side. So the first item on there I want to talk about is increasing the overall top tax rate from 37% to 39.6%. And this would apply for any taxpayers earning over $400,000. So this rate, the 39.6%, was actually our old top individual rate during the Obama and Biden administration. And the $400,000, and you're going to see that used throughout this slide, the $400,000 is really, I don't know if you want to call it the line in the sand that the Biden campaign has sort of set, where they've basically promised to not raise taxes for anyone under that income threshold. So for anyone earning under $400,000. Now, moving on to the second bullet point here, taxing qualified dividends and capital gains at ordinary income rates. Now, this would only apply for taxpayers earning over $1 million annually. So it's not that $400,000, it's significantly higher than that amount, but it could really impact quite a few areas. Right now, our current top capital gains rate is at 20%, ignoring any net investment income tax. So you're looking at going from 20% to potentially 39.6%. So you're looking at basically doubling that rate that people over $1 million of income would pay on capital gains. And the thing here, it's not just simply looking at a brokerage account to really determine the impact of this. So, going back to what we discussed earlier on the long-term planning side, should you stay as a partnership or an S corporation, or is it time to convert to a corporation, or doesn't really, not is it time, but does it make sense to convert to a corporation? Well, again, let's say you are a closely held business and you pay out dividends or distributions on a regular basis to your owners, and those owners make over $1 million a year. Well, you could be looking at, up to somewhere between 55 and 60% effective tax rate under or due to this proposal on capital gains. So with a rate that high, that would obviously discourage anyone from converting to a corporation. But if they are already a corporation, and let's say they converted, 2 years ago because of the decrease in the corporate tax rate, well, they'd obviously be looking at and rethinking their current business structure. So it's more than just looking at your brokerage account to determine the impact. It's really looking at, if you are a business owner, how will that impact my current business structure? Now, moving on to the third bullet point there, this is one of the largest, subjecting earnings over $400,000 to Social Security payroll tax is one of the largest revenue raisers included in the Biden proposals. And it's probably not getting as much conversation as some of the other items on there, like increasing the top tax rate. So, currently you stop paying Social Security tax when you get to about $140,000 of, W-2 wages or self-employment income. So this would remove that cap and subject those earnings to an additional 12.4% Social Security tax once you are over $400,000. So again, thinking about this, you'd go from zero to, for simplicity's sake, we'll go zero to $140,000, where you'd pay Social Security tax. Then you'd go from $140,000 to $400,000 of not paying Social Security tax, and then from anything $400,000 and above, you'd pay Social Security tax on. So that is a pretty significant tax increase for people earning over $400,000, because you're looking at a 6.2% on the employee side, as well as a 6.2% increase on the employer side. So it's going to be close to a 12.5% tax increase shared between the employee and the employer. Now, moving on to the right-hand side of that slide, actually, let's talk about estate tax changes first, kind of tying this back to succession planning. And the one thing I want to point out here is that right now, one of the proposals is talking about eliminating the step-up in basis at death. And currently, when a taxpayer passes away, their heirs or the next generation receive a step-up in basis on their assets they inherit, and they step that up to fair market value, regardless of whether or not you have a taxable estate. So if this goes away, you could be looking at two possibilities. Number one, the heirs would either inherit that historic lower basis and then recognize the gain when they actually go ahead and sell that asset, or all unrealized gains would be taxed at death. So your estate, would more likely be forced to actually sell capital assets in order to pay any estate tax liability. And this is generally a big change from our current tax policy, since the general rules are we like to wait until an event happens, like let's say actually selling stock, before taxing you in order to avoid any forced sales to cover that income or estate tax liability. Now, very quickly talking about a business proposal or two, obviously we have the increase in the corporate tax rate from by 7%. So it would go up from 21 to 28%. And then the other item I want to mention on there is the phasing out of the qualified business income deduction for any taxpayers earning over $400,000. So the qualified business income deduction is that 20% deduction on business income from your pass-through entity. So if you operate as a partnership or as an S corporation, you may be able to receive this deduction, and you may have been taking this deduction on your 1040. So the loss of this deduction, again, if you made over $400,000, and also depending on what the top individual tax rate ends up being, you're looking at an increase on business income, increasing tax on business income of about somewhere between 7 and 8%. So again, looking at the corporate side, on the first bullet point, it's a 7% increase. And then on the pass-through side, as an S corporation or a partnership, again, if you're over $400,000 in income, you're looking at a very similar increase in your effective tax rate as well. So I want to save a couple minutes for questions. So I'm going to turn it back over to John to, if any questions came back in, to help moderate those. So John?
Yeah, thanks, Tony. A lot of food for thought, a lot of things that, again, our what if and crystal balls are probably pretty foggy these days. I think it was Tom maybe talking about the horizon being 6 feet in front of you, but it's so cloudy, still hard to tell what that horizon looks like. So if there's any questions, we would, we got I think Gary Tarsha. If you've got a question, I don't know if we can unmute you, but if you want to pose a question, maybe Samantha, you might have to help us with that one.
Yeah, we'll try and unmute you. And then Gary, if it doesn't work too, you can always use the chat and Q&A panel too. So that works also. So Gary, I'm going to give that one try here.
And I would also add that, to the extent there's questions that come up after today's presentation, if you look at the materials, don't hesitate to reach out to us, send us an email. Contact information should be available on our website. Give us a ring at any time.
Yeah, so John, I'll just go ahead and pull up your contact information one more time there too, so everyone can see emails. Gary, it looks like, oh, maybe you're unmuted. Go ahead.
Am I unmuted?
Yes.
You sure are. Welcome to the presentation.
The 400,000, is that total? Is that taxable income, total income? Do we know at this point?
Yeah, it's not very specific on what it is, whether or not it be sort of single or married filing jointly, but it's generally when it comes to this, you'd be looking at taxable income, but who knows at this point what it's actually going to end up being.
Yeah, it could be AGI, it could be taxable income, could be total income.
Yeah.
Yeah. Okay.
Exactly. Yeah.
Yeah, very undefined at this moment, and I think a lot of it goes back to the campaign discussions and the 400 sticking out there. I don't think anything's been really defined yet, but yet to be determined in the next probably week to 4 weeks, depending on when it all gets decided. A quick question, and I think we might be able to close out with this one. It'll take us up to the top of the hour. Vicky Ernst says, I joined late and had to post a question that was likely already addressed. Balance sheet treatment at 12/31/20 on the PPP loan, proceeds received in 20. And we did talk briefly about that, Vicky. It really is a loan until it becomes forgiven. So balance sheet treatment would be a liability as of 12/31/20 unless you actually receive formal forgiveness. So that's where it is. And when it becomes forgiven, again, there's a lot of yet to be decided rules or interpretations, guidance, and or legislative changes that might dictate what that will look like in 2021. But it will be a loan until it is forgiven, and then the tax treatment will soon to be followed.
Perfect. Well, John, Tom, Tony, thank you all so much for all the information today, all the questions. I know we received a couple via email too, so if we couldn't get to anything throughout the presentation today, we'll just follow up individually. But with that note too, always work with your business advisors. The Raymond team is so excited and looking forward to helping all of you. We're going to continue to have webinars throughout the end of the year, so you'll see additional invites, especially with a lot of the stuff Tony covered with the upcoming elections. Really looking forward to it. But seriously, thank you for our panel of speakers today. Thank you all so much for attending. We appreciate your time. And the recording, the slides from today's presentation will be sent out via email. Any closing thoughts, John, Tom, Tony?
Nope. Thank you very much, Sam, for all your help.
Absolutely. Well, thanks, everyone. Have a great day.